Welcome back to Primary Source China Investment. Peng Guo and I are here for show X2. I don't have anything pithy about that. It's just show X2. And this week we wanted to talk about the markets because the markets don't stop. Things do move forward. And if you recall studying back in undergrad, whenever you looked at long series of data, we would sort of take out the war years as if they didn't happen. Unfortunately, events that dramatically move markets is not an excuse to stop evaluating what's going to happen going forward. You know, we could argue that the COVID effect on global GDP, unemployment, and trade is at least as significant as war. And now Russia, Ukraine has entered the chat. So without dismissing the human toll, it's our job to interpret what's happening globally to assess the directionality of China's economy and markets. So that's what we're going to do. There's been a small but vocal contingent using the word uninvestable. Regular listeners have heard us discuss this phenomenon for many months, and it's this: if you want to own securities, China-related, you have to buy assets listed on the mainland. This still carries the usual beta risks, also carries some regulatory risks, like a halt in trading by the US exchanges or the SEC. So if we look at Russia right now, Moscow closed its exchange, but US ETFs continued to trade until Friday when all were halted. And that was from a regulatory reason. Peng Guo, last week you mentioned that investors need to be patient with respect to looking at China. Are you still in that patient perspective right now?
China is a still emerging market. So similar like other emerging markets. As a whole, all the emerging markets have higher volatilities than the developer market. So that's pretty sure. Many reasons behind that.
Yeah.
It's very hard to predict what kind of risk or design a model to capture it. From our investment philosophy, the best way is to stay in the uptrend. As long as uptrend is over, just be patient, wait for the next back to the uptrend. How long? It's maybe like a few months, maybe in the whole year. It's also happened in the China market.
Right.
So the longer period, the bounce back would be higher. The market always get balanced by itself by some way.
So it's really talking about this asset allocation model. Again, you know, we've talked about it in the past, and you know, when markets go up, it's great to be in the market, but when market goes down, you need to reallocate into either cash or some fixed income.
That's right. So if you keep stay in the same asset, it will be very risky. So because you don't know where's the bottom. And most of the time, people enter it probably at a high point. If at the bottom, they have no interest to come in, even the institutional client. So probably they enter in the middle way or pick away and then go down. That will easily cause a huge loss.
That's the retail
most of the time, yeah, even for the institutional investors, they cannot afford like that more than 20% of the loss. Right. If more than 30%, they definitely will leave.
Right, and for U.S. investors, you know, we've talked about, and we put together a little portfolio that has U.S. listed companies that do more than 50% of their business in China, and we would be remiss if we didn't revisit that from time to time. So, you know, we called this the third way. And we wanted to compare that portfolio to A shares, which are China listed and the big name China companies listed in China, EWH, which is the Hong Kong listed companies. Again, a lot of big state-owned Chinese companies listed in Hong Kong, KWEB, which is the largest US traded ETF for China-based companies. Again, a lot of those tech companies, and you know, the S&P 500 just for a benchmark. So if we look at the returns, this model portfolio is down 88 bips since July 28th when we first proposed it, but it's outperformed basically everything else. So A share is down a little bit. EWH Hong Kong is down about 13%. KWEB, as we all know, has gotten killed. And the S&P 500 is down 1.22. So you're going to get correlation between our portfolio NAV and SPY, because the holding of our portfolio is a lot of US listed companies: Qualcomm, Micron, Texas Instruments, Broadcom, these are companies that trade on US exchange. So you're going to get a big dose of beta with that.
That's definitely a great idea. Yeah. So I totally agree. So as long as the company get the exposure to the Asia or China mainland market, so they will enjoy the growth from mainland market, as well as they also have other business or keep the balance, migrate the country level risk.
Right. So these are international companies, clearly, but China is driving a big portion of their sales at the moment, and this is going to change. There are other companies that are going to walk away from China. There are other companies that are going to enter into China. There was an interesting interview with SEC Chair Gensler on Friday, and he was giving an update on the Public Company Oversight Board, which, for those of you who have forgotten, is an entity that inspects the financial statements and the articles of incorporations of companies listed in the US. More than 50 jurisdictions representing over 1,000 listed companies have signed off on this, but China has not. So 18 months ago, Congress passed something of a compliance clock that said, if auditors on the mainland don't open their books of their clients to inspection, then those companies would be forced to delist. And this is no small event, because the clock runs out in 2024, and there are 250 China-based companies listed in the US. So something has to give here. And Gensler had some positive comments. He was saying, look, we've had good conversations with China. It's really in their court. His hands are really tied because Congress passed this law. So investors looking at those Chinese names that are listed in the US have to be wary of this. It would be a very heavy hammer to come down to delist 250 companies, but it's not off the table at this point.
That's also like another huge risk, a total regulation risk.
Right. So
that is hard to predict and could easily affect a lot of things. But overall, you probably see that companies, that's why the K-Web get dropped 40% in the past year, probably just price in such kind of the regulation risk.
For the bigger companies, it's not a problem. A lot of the smaller guys, the compliance cost is going to be way too high for them. So they'll probably delist.
Yeah, I agree. So I think in the United States, like the legal cost or compliance related cost is really much higher than China. Obviously, there's many reasons behind that.
Yeah.
From the company's perspective, they have to evaluate the risk and as well as the potential benefit with that. But the tragedy since is for the investors. So all those shareholders, they will suffer the huge loss with that. But I think that's a pretty bad thing for not just for current company and also for the industry development. So if they want sector growth in the future, then other good companies will find it's harder to raise the money in the capital market. So that will have the bigger effect impact on the sector level.
Do you think for big names listed in the US like Pinduoduo or Jingdong or even Alibaba, do you think listing back on the mainland or in Hong Kong will give them a higher valuation?
That's definitely true. So I think this is general speaking. So all the countries in their home country, so they will get the higher valuations. So that's definitely true. I see the statistical research before. That's the best place. So they choose to list in the United States for many reasons.
Of course, yeah, we covered that, and I think that's going away. Some of those reasons may be going away, but
that's true.
But I do think that's another endorsement for A shares, because if these companies do go list back in Shanghai, Shenzhen, even the new Beijing, they're going to get a bid, and I think the valuation goes up.
It's hard to say that, but at the same level, if you see the A share and H shares, you will see the A shares valuation is much higher than the H shares. Most likely, I bet them they want to dual listed.
Dual listed, yeah, I think so. Yeah, dual listed. All right, so the final thing that I wanted to talk about was some macro numbers, and where do we go from here? China PMI disappointed in February, came in at a 50.2 versus 53, which was expected. and a 51.4 for January. So it's really a mixed picture. It's sort of up and it's down, better than January, but still the lowest rate for 6 months. China also just set the lowest GDP growth target in 30 years at 5.5. So, maybe the trend following, be cautious is still the place to be, and also keep close to the biggest names that are closest to Beijing.
So yeah, that we know right now current economy is not good. So probably the global economy is not good. People just recover a little bit from the pandemic, unfortunately, and right now it's getting the war. So this war really impacted the global economy, especially for the equity investors. So that is a lot of the supply chain companies and bad debt, they will be disclosed gradually. So nobody knows what's going on with that. So I really hope they can reach some peace agreement as soon as possible. Yeah. Otherwise, all the countries, nobody can avoid such kind of the war.
Yeah, that's the tragedy. So we're going to leave it there.
That's true.
Peng Guo and I do our job, which is talk about investment, but we do understand that there are other things happening in the macro environment, so we tried to incorporate that into our view on China. Thanks for tuning in. Show X2. We'll see you next week.
Thank you. See you next week.